Hi everyone, we're going to go ahead and get started. Welcome and thank you for participating in our Severance Tax webinar today. My name is Abbey Pizel and I am the Natural Resource Policy Analyst with the Colorado Fiscal Institute. Just a little bit about CFI. We focus on fiscal and economic implications of policy affecting working families, as well as how public resources are allocated to meet public needs. Because of Colorado's abundant natural resources, CFI expanded our capacity to include natural resources and environmental policy, and that's why we're excited to have you here today participating in this webinar. I would like to just briefly introduce my co-presenter to you, Mr. Bill Levine, the Director of Budget with the Department of Natural Resources. Mr. Levine has been a budget analyst with the Department of Natural Resources since 2002 and was named Budget Director for the department in 2004. Bill came to the department after working 6 years as a budget and policy analyst with the General Assembly's Joint Budget Committee. Just a few housekeeping notes before we start. This webinar will be recorded and uploaded to the Colorado Fiscal Institute's website. We will send a note to you all with that link after the webinar. We will be answering questions at the end of the webinar, and until then, please keep your phones or computer microphones muted as they are now. And you can chat questions to us at any time using the chat feature, or you can unmute yourselves at the end of the webinar and send questions then. If you have any technical difficulties, please chat them to CFI or email us at info@coloradofiscal.org. Now let's get started. This is just briefly a roadmap of today's presentation. We're going to be going over why states have severance tax, Colorado's severance tax, other than oil and natural gas, and then oil and natural gas severance tax. Where does the money go, and some of the challenges facing severance tax. First, why do states have a severance tax? Well, many Western states with abundant natural resources like Colorado choose to offset some of the impacts of taking those resources by levying what is called a severance tax. And these severance taxes offset cost to communities in this state from taking resources out of the ground and gaining private profit. So what does severance tax look like in Colorado? Severance tax in Colorado is levied on the production or extraction of natural gas, and it's used to support programs that build thriving communities and for natural resource management. Because in Colorado, severance tax is levied on oil and natural gas, and 95% of that is from oil and natural gas. The majority of this webinar will focus on that. But first, I just want to briefly touch on severance tax other than oil and gas. There are three key components of that. The first is coal. The Department of Revenue publishes a rate monthly for coal, and right now that's sitting at about 0.846 as of April. That was a preliminary rate. The rate published in January was 8.32, so it's gone down just a little bit. The other components that pay severance tax are metallic minerals and molybdenum. And this table just shows briefly some of the exemptions that are covered with them and some of the rates. With that, we'll go to oil and gas. As I said before, 95% of the severance tax in Colorado comes from oil and natural gas. Before we dive into that, just a few of the tax basics to help us get acquainted with how the severance tax for oil and gas is structured in Colorado. First, we have what is called a tax base, and that's the measure of value upon which a tax is levied. So for example, income tax, your tax base would be your wages or your salary. For property, it would be the assessed value of your real property, such as your home. And for severance tax, the taxable base is something called the value at the well, or the value at the wellhead, also known as the gross production value. The other important piece of severance tax structure to note is the tax rate, and that's a portion of the base paid in taxes. As I mentioned before, coal's severance tax rate is 0.846 as of April 2019. And so with that, we're going to move into Colorado's oil and gas severance tax base. When we calculate the taxable base for oil and gas, there are two essential ways that states do that. First, you could tax the volume of oil or natural gas produced, so the number of barrels, or the MCF of natural gas. The second way that states can tax oil and natural gas is the value. Colorado has a kind of unique taxable base in that we tax the gross production value. And what that is the value at the wellhead or the value of the mineral when it comes out of the ground. Well, there is no value associated with that. And so how Colorado arrives at their taxable base is they take the resource, the market value of the resource at the first point of sale, whether that be a gas station, a retailer, or a wholesaler. And then, because there are inherent costs incurred by the producer to arrive at the market value, such as transportation, manufacturing, or processing, producers are able to deduct those costs from the market value to arrive at the wellhead value or the taxable base for oil and gas production. So we have the market value at the first point of sale. We deduct any costs associated with transportation, manufacturing, or processing to get to the product to market. And that is what Colorado defines as a taxable base, or the value at the wellhead of the resource when it comes out of the ground or is severed from the ground, which is where we get the severance tax name. It's really confusing, and if you have any questions, please feel free to chat them. It's a very complicated process to get the taxable base. So once we have the taxable base, we can apply the rate. Oil and natural gas in Colorado's rate is on a graduated scale from 2 to 5%. If you're a producer and you make under $25,000, you pay 2% in severance tax. If you make over $300,000, you pay 5% in severance tax. And that's applied to the taxable base or the value of the mineral at the well. Some of the other taxes that oil and natural gas producers pay in the state include property taxes. And oil and gas property is assessed at 87.5%. This number is really important when we later talk about some of the credits, exemptions, and deductions for severance tax. Producers are also charged a corporate income tax. In Colorado, that rate is 4.62%. And then they also pay sales and use tax of 2.9%. All of these taxes are applied to the same taxable base or gross production value. To add to the complexity of severance tax, Colorado allows producers a myriad of deductions, exemptions, and credits. The first and probably the most complicated for the severance tax is something called the ad valorem credit. An ad valorem is just a fancy way of looking at property taxes, and in this case, it's similar to a property tax credit. So as I said before, oil and gas produced in the state is assessed at 87.5%, meaning that you pay property taxes to local governments on 87.5% of the value of your production. So if you make $100,000, you pay property taxes on 87.5% of that. What the ad valorem credit does is say, okay, you paid 87.5% in property taxes. Well, then you can take up to 87.5% of your property taxes paid as a credit against state severance taxes owed. And what this does is create a lot of volatility, which Mr. Levine will touch on a bit later. And then the second exemption is something called the stripper well exemption. It's a little bit more straightforward. It allows producers, low producing wells, to be exempt from paying severance tax. The metrics are listed on the slide. If you produce less than 15 barrels of oil or 90,000 MCF of gas, then you do not have to pay severance taxes in the state of Colorado. The final deduction is something that refers back to calculating the taxable base for oil and gas. As I said, they're allowed to deduct costs for transportation, processing, and manufacturing to get to the market value. But in 2016, a Supreme Court case, BP America versus the Colorado Department of Revenue, added one more deduction to that calculation. Producers in Colorado are now able to deduct their costs of capital when calculating their taxable income for severance tax. So that's the basic structure of severance tax. We have the taxable base, which is the value at the well. We have the rate, which is 2 to 5% on a graduated scale. And we have the exemptions, deductions, and credits applied to state severance tax collections. Now we're going to switch gears a little bit and look at what does an oil and gas producer in Colorado actually pay, taking into account all of these deductions, exemptions, and credits, and the state severance tax structure as a whole. So here we have from the U.S. Energy Information Administration a breakdown of what the effective tax rate is for Colorado. And what the effective tax rate is essentially state severance taxes and then any deductions, exemptions, or credits added in. So in 2008, producers paid roughly 2.1% in severance taxes, or $262 million. In 2016, the effective rate dropped down to 0.3%, and producers were paying roughly $28 million. Some of these fluctuations can also be attributed to severance, the oil and gas industry's volatility in the global marketplace. Fluctuations in global price of oil may also result in some of these larger fluctuations. But overall, the effective severance tax rate in Colorado is relatively low, especially when we look at ourselves compared to other states. This is a table produced by Legislative Council, and they calculated the effective severance tax rate for Colorado compared to other surrounding and western states. Montana has the highest effective severance tax rate at 10.5%. Texas, the largest producer of oil and natural gas in the country, has an effective severance tax rate of 3.9%. And in 2016, Colorado was sitting around 0.6% effective severance tax rate. We could also look at state severance tax, including all the other taxes that oil and gas producers pay. And when we do this, we see that Colorado moves up to the middle of the pack when we account for things like property taxes, income tax, and sales and use tax. The effective rate shifts to about 6.4%. But again, states like Texas, Wyoming, and Montana are paying substantially higher taxes for oil and gas producers. And with that, we will shift to Mr. Levine to go over where does the money in Colorado go.
Great. Thank you so much, Abby. So in terms of where the money goes, I think the first chart is one I've been using for years to help explain that. I'm going to start at the top and show you how severance tax revenue flows through a statutory allocation system. I'm a numbers guy, so if you are a numbers person yourself, that top box, the total amount of severance tax revenue the state collects in a year, averages about 160, 165 million per year. But as Abby said, it's very volatile, and so average is only average. There are years that are much more and much less than the 160, 165 million that I'm talking about. But if it helps you to get a sort of a magnitude of what we're talking about, I think it's helpful to have the numbers, again, as a numbers person. So whatever amount of revenue we collect in a year, again, is that top box. And what statute does is immediately takes that amount and splits it between two departments in the state of Colorado. 50% of the revenue goes to my department, the Department of Natural Resources. And the other 50% goes to our sister department, the Department of Local Affairs. Just to speak very briefly about the Department of Local Affairs, they take their money and distribute it through two programs back to local governments. One is a direct distribution back to the governments that are essentially are where both the employees and the minerals come from. And then they also do a grant program back to the local governments, again, trying to help out communities who are impacted both by the growth cycle in minerals and energy. So if there's lots of new production happening, new employment, they may fund new schools, new roads, new fire services. And they also look at the back end of the production cycle, so the bust part of the cycle. And when the revenue stream and the minerals go away, it can really leave local governments in a tough situation. And so the grant program also helps when that economic activity goes away. So that's the Department of Local Affairs piece. Speaking to it at a high level because that's about the level of knowledge I have of it. I will speak a lot more about the Department of Natural Resources side for the rest of this presentation. So again, we get half of the revenue, and we at DNR take our half of the revenue and split it into two then equal pieces, and there are two funds. You'll see there on the chart. First is the operational fund that gets 25% of the total revenue. And the other fund that gets some severance tax revenue is the Perpetual Base Fund. It also gets 25% of the total revenue. I will talk first about the Perpetual Base Fund. The word perpetual is an important part of describing what the fund is about. So theoretically, it gets the money and is supposed to maintain it in perpetuity for the benefit of Colorado. And that manifests itself in the fact that it is about a $400 million fund in terms of what accountants, and I hate to speak accounting, so I'm going to apologize in advance, but accountants would call that fund equity. And the majority of what that $400 million does isn't sitting there in cash. The majority of it is actually something called a loan receivable. So we get the money and we loan it out. And the purpose for which we loan it out is for water projects. And we do that through the Colorado Water Conservation Board. And those loans are intended to help build water infrastructure around the state of Colorado. So this perpetual fund at the $400 million and with the new money flowing in the door generates about $47 million in an average year for the Water Conservation Board to loan out for new water projects and specifically water project loans. And of that $47 million, again, I mentioned the revenue stream, and I'm going to use the number with the simple math. If the revenue stream were $160 million in your average year and it's getting 25% of the revenue, that means about $40 million in new revenue is flowing into the Perpetual Base Fund. And then it's also earning about $6 to $7 million in loan interest. And that's both on the cash that it does have, which is the smaller piece. And then the money that it loans out at a advantageous interest rate, but an interest rate nonetheless. So it's generating interest income that's returned to the state and is an additional source of revenue for the Water Conservation Board to do additional water projects. So again, that's where we get about $47 million per year in new revenue for this need. And that probably sounds like a good amount of money, and in some ways it is. I'm someone who always looks at the glass being half empty, and my last bullet point is to that point. Even though it is a great source of revenue for us and does allow us to do a lot of things to help build water infrastructure around the state, the Water Conservation Board has done some studies and looked at the needs of the state and water infrastructure needs in particular. And because we are a growing state, over time, it's estimated that we are going to need a bunch of additional water infrastructure to meet population growth and water demand in the state. And the current thought is that we may need as much as $100 million of additional funding to address the state's water infrastructure needs over the coming years. So even though we're getting this great source of revenue, point I guess wanted to make is it's probably not enough to address all of the water needs of the state. The other fund where our severance tax revenue is deposited is a much more complicated fund. So the Perpetual Base Fund is a water infrastructure fund. It's simple in purpose. The operational fund is much more diverse in the purposes for which it's used. Another interesting comparison, I guess, is my first bullet point. So I mentioned that the Perpetual Base Fund is a $400 million fund in terms of fund equity. The operational fund is completely different. Even though it gets the same amount of revenue coming in each year in terms of new severance tax revenue, they each get 25% share. Fund equity here over the last bunch of years has ranged from about 17 million to as high as 34 million. So a much smaller fund in terms of equity in the fund. And the reason for that is that unlike the perpetual based fund where you're trying to keep a perpetual balance, the operational fund is a spend as you go operating fund. So every year the money comes in and every year we spend it as we earn it. Again, the revenue stream here is about $40 million. It's that 25% share. And because it's such a small fund balance, there's not really much interest income that comes into this fund. We fund two broad categories of expenditures out of the fund. The first is what we call core programs. I'm going to use my favorite term because I coined it. We also call those tier 1 programs. A bill was passed this year that eliminated my term, and so I'm not too happy about that, but I did not have veto power. The other thing that we fund out of that are grant programs, formerly referred to by me and some others as tier 2 programs. And I will tell you what each of those two terms means in my next two slides. So let's talk about the core programs first. The core programs fund programs generally at the Department of Natural Resources. These are all identified in statute as eligible core programs. I guess I'll talk about the first two in a group. So we fund some of the activities, about a third of the budget of the Oil and Gas Conservation Commission is funded as a core program. That's 6.2 million. And then the other thing we fund are programs in the Division of Reclamation, Mining, and Safety, and that includes the regulation of coal mining and metal mining in the state of Colorado. That's at 4.8 million. And those two purposes alone represent about 2/3 of the core program spending. And I've always thought that that was an extremely appropriate use of the money in the sense that it's essentially going to regulate the activities that generate severance tax revenue. So those, again, to me are very appropriate core purposes, great uses of this money. On top of those two, there are several other core purposes. We fund specifically at Parks and Wildlife, we fund state park operations to the tune of about $2.5 million per year. This is the one program that is not at the Department of Natural Resources, although it was when it was first funded. The Geologic Survey, which is now at the School of Mines, gets $1.6 million to help subsidize its operations. The Water Conservation Board gets $1.3 million, and the Avalanche Information Center is the smallest core program at about $600,000. So those are the core programs. We fund those by statute first. If there's money left over after funding the core programs, and I guess I have that number at the top, that's about $17 million to fund the core programs. Any money that comes in above and beyond that would theoretically flow through to the grant programs, which I will now describe, and so that's the next graph. This is where the operational fund gets really disparate in its purposes. So the largest grant program is LEAP. I'm throwing some acronyms at you, so I will apologize and help you through that. LEAP is the Low Income Energy and Assistance Program. It funds both helping Colorado citizens pay their home heating bills, and it also funds projects for citizens to weatherize their homes. That is to the tune of about $13 million per year, and that is funded actually through 3 different agencies, none of which is the Department of Natural Resources. So it's the Department of Human Services, the Governor's Office, and a nonprofit called Energy Outreach Colorado get portions of that amount into one, which is $13 million. The second biggest program is another acronym, the Water Supply Reserve Fund, is a program at the Department of Natural Resources through the Water Conservation Board, and that funds water projects, water studies, water programs of local importance. So local watersheds will decide what they need to address water issues in their part of the state and get grants from the Water Supply Reserve Fund to address their priorities. We also fund about $5 million per year in species conservation efforts through 2 of our agencies at the Department of Natural Resources. We fund the Aquatic Invasive Species Program. If you've ever heard of zebra mussels, this is our effort to combat things like the zebra mussel. That is to the tune of about $4 million, and that's for boat inspections, boat decontaminations at Colorado bodies of water. Now, another program that's not through our department, but one that we're very interested in. We fund forestry grants and wildfire prevention grants Those are generally through the Colorado State Forest Service. Some of that money does also go to the Department of Public Safety. There are some miscellaneous water programs, including water efficiency to the tune of about 1.3 million. The Department of Agriculture gets about $500,000 per year, and a very small amount of money, about $120,000 per year, goes to reclaim forfeited mine sites in the state. So these are sites where the operator has essentially walked away from the site. And we have a bond, a financial bond to help us with that, but there's usually a difference, and this would fund that difference so that we can fully reclaim sites where the operator went bankrupt, walked away, and we need some money to help reclaim those sites. So again, about $120,000 per year for that final program. Again, on the glass is half empty side of the ledger, I'm going to walk you through the math of the operational fund, which has been my life for most of the last 15 or 20 years. And this is looking at the average math. So every year is different, but in the average year, $40 million of new severance tax revenue will come into this fund. We earn a very small amount of interest income on the cash as it sits waiting to be spent. Again, this is a spend as you go account, but with that much money, there is a little bit of interest income that's generated. So we have a little over 40 million per year to spend. Those are the two pluses. And so we start spending, and the core programs are authorized at 17 million per year. And the tier 2 programs are authorized at $36.4 million per year. And I don't know of the group here listening, how many of you are math people, but for those of us who are, those numbers don't add up very well. And in fact, what you get from adding all of those pluses and minuses is that on average, authorized spending is $13 million greater than the average amount of revenue that flows into this fund. I hope that we all get that that is a big problem. So let me talk about what we do a little bit, and maybe this is a later slide, but this is a great place to do it. I'm going to stay here for a moment. When we have spending authorized at greater than revenue, something has to give. And the something that gives, I mentioned that the core programs are core for a reason. They're funded first. If we don't have enough revenue, we would have to proportionately reduce the grant programs to make the math balance. So very roughly speaking, in the average year here, we would have to reduce those grant programs by about 1/3 to make that math work. And so that's your average year. So as soon as you get into a below average revenue year, those 1/3 reductions are going to get bigger. So a little preview of how all of that works. Now I keep talking about the average year. So let me now talk a little bit more about why do I keep using the average year. And both Abby and I have mentioned that it's a very volatile revenue stream. And this to me is the graph that I like to use to show how volatile the revenue stream can be. So just to walk you through a few of these numbers and make sure that the appropriate perspective is put on them. The first year that I put here is fiscal year 07-08. We earned $152 million in that year, and that was really a pretty close to average year. The very next year, the revenue stream doubled, more than doubled, to $319 million. And then the very next year after that, the revenue stream declined by almost 90% to $36 million. So I think just in those first 3 years is a great example of the $319 million is actually the statewide record. And immediately upon establishing a record, what we did is follow that up by 90% reduction. So we went from a high to a low in unbelievably record time. It's kind of wild ride that the severance tax revenue stream is known for. And you can see fairly good volatility in the next bunch of years. And then we again hit a record, not a record, but a very high year at 271 in fiscal year 14-15. And I've kind of come to learn that as soon as you see things and think, wow, severance tax revenue is really great, and as a financial person you think things are going well, that's the first warning sign that things are about to go bad. So that's exactly what happened following the great year in fiscal year 14-15, is it plummeted to 67 million the next year. And in fact, the year after that, and this goes back to the BP case that Abby briefly mentioned, we would have actually received a negative $7 million of revenue that year had it not been for legislation that the General Assembly passed. And so it may be a little mind-boggling, like how can you have negative revenue? That sounds like a government thing, and actually it kind of does sound like a government thing. what that means is that we paid out more in refunds than we actually took in revenue. Now, remembering that the Supreme Court decided a case, the BP case, we had some liabilities that we had to pay as a result of the BP case. That is partly why we had more refunds than we had revenue. We also were paying out a very, very large amount of property tax credits back to taxpayers. That was a big piece of that year crashing in general, and BP just made it worse. So again, huge amount of volatility. I tend to look at this chart and think to myself, WTF. Sorry, it's another acronym, maybe appropriate to keep it an acronym. I will say that I took this chart just in trying to understand like what is going on with this huge amount of volatility. Why do we experience this kind of whipsaw volatility in the revenue stream? So I'm a Boston guy myself. I took this back to my hometown of Boston and sought out the most intelligent man in town. Many of you may think that it was someone at Harvard or MIT. We've got lots of smart people in Boston. But I'm not just talking a run-of-the-mill, really smart person. I went out and sought out the smartest person in Boston. And for those of you who know Boston well, you would know that you would probably find this person at Cheers. There he is, the smartest guy that I sought out was Cliff Clavin. And I showed the chart of the volatility in the revenue stream to Cliff Clavin. And Cliff Clavin's response was, oh yeah, I get that, that's WTF. And then I said, yeah, that was my reaction too, but I'm not sure you're using the term the same way I am. Can you define for me what you mean by WTF? And I was really just baiting him to cuss. And the reality was, he said, oh yeah, WTF, wicked taxation fluctuations. So that's a term I don't use. I'm not Harvard educated. I'm not sort of his intelligence level, but I think WTF, wicked taxation fluctuations, is exactly what you should think about when you think about severance tax. And it does create a lot of problems, and I want to talk about some of those, and I did mention the proportional cuts as one of the ways we deal with that volatility. So that was the first bullet point, and I skipped ahead to that. I couldn't help myself. Another thing is, remembering this creates problems, that we spend the money as we earn it, and that can create a lot of problems for us. Because oftentimes we're dealing with an estimate of how much we'll earn, and the money is already flying out the door based on an estimate. And that got us in a little bit of trouble a few years back. So in 17-18, we almost spent money that we were projected to earn, but in fact, it later turned out that we weren't projected to earn it anymore, but some of the money that we didn't have was already spent. And we narrowly avoided that problem with help from the General Assembly. And we learned from that experience. And last session, or I guess it's this year's session that has just ended a little bit ago, the General Assembly passed Senate Bill 19016, under which we will no longer spend our grant funding as we earn it. We will wait and spend it a year later, or in arrears is the term that everyone was using. And that's just a much more responsible way to spend that money, because after the year that you've earned it, you can wait for the dust to settle. You'll actually know how much revenue you have, and then you will spend it. So really glad to see that change happen. Just a much better way for government to operate, much more responsible. We're spending with information instead of spending in the dark. So really happy with that change. And my last slide is this one, again, just talking about what are the impacts of this volatile revenue stream? What are the impacts of the more recent downturn in the revenue stream? I mentioned that we do proportional reductions to tier 2. So the middle column there tells you what the grant programs were actually funded at. So 72%, 101%, 100%. Then things started to go south. We funded things at 91% in 15-16. And then when those really bad revenue years kicked in, we had 3 straight years where we funded these programs at 0%. So again, I talked about how on the average year we should be cutting by 33%. Well, when we had significantly below average revenue, it came to the point where we were now funding things at 0% for multiple years in a row. There's an asterisk on one of those zeros. I think there should actually probably be an asterisk on 2 of them. I will say this is the amount of severance tax revenue that flowed to all of those programs. We were able to work with the General Assembly Senator Rankin and others were really helpful in coming to us and talking about what are the impacts of there being no severance tax money for these programs. And we did fund some of our highest priority programs. The Aquatic Nuisance Species Program, the Species Conservation Program, and the Forestry programs jump to mind. I think those are the three biggest. We did fund some of those programs with general fund revenue, so it wasn't a complete disaster for those programs. I will say in particular, something that just jumps out at me is that the Aquatic Nuisance Species Program is the kind of preventative program that you can't just fund when the revenue is there. If we're going to prevent zebra mussels from being in our waters here in Colorado, we need every year to inspect the boats that are coming in, make sure they're not infested with the zebra mussels or other non-native species. Again, in the good years, you have to do that every single year or you will be infested in the bad years. So we have worked with the General Assembly to find solutions to some of this, but it definitely remains problematic as well that we are that we've funded these programs at 0% for 3 years. And I think all of the programs have been looking at alternatives. And if you're interested in one of the programs that is funded out of this, it's important that you understand what is authorized out in statute may not be what you get, and it may be quite different. So that wraps it up for me. I think now we are going to turn to questions from you, the audience.
Great. If you have any questions, feel free to unmute yourself and ask them, or also type them into the chat box. We covered a lot of material. Severance tax is a really complex tax in Colorado. So if you do have any questions, you can contact me. My email is listed here, or Mr. Levine, and we can send you his email as well, or ask any questions you have now.
And as a reminder, we are recording this video and we'll be sending it to you all who've registered. And it will also be on CFI's website. You guys did a great job. There's no questions. The main person is typing, otherwise. Cool. Have some like music, background music, and playing.
I hope I didn't scare them off with all my half-empty references, but I do want to thank the Fiscal Institute for raising this issue. I think severance tax is a really important issue for the state. Funds a lot of important programs, and appreciate you guys putting the spotlight on.
Yeah, of course. Thanks for partnering with us.